telling me that you have a way to defer the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The Deferred Sales Trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
Hello, everybody. Welcome to another Capital Gains Tax Solutions Masterclass, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy. And using a proven tax deferral strategy, such as the Deferred Sales Trust, or some other tax deferral strategies as well, can help you create and preserve more wealth, or help your clients do the same, and unlock freedoms or challenges that people are facing when selling businesses, cryptocurrency, real estate, not wanting to feel trapped by a 1031 exchange. Perhaps they're separating a partnership or retiring, or a number of things that you could be going through with your wealth plan, with your exit planning. And let's face it, time is short, and sometimes we want to be able to spend time with our loved ones. We want to be able to spend time maybe starting a new business venture. We want to be able to be doing what we want to be doing. And so what we like to talk about in this mastermind, this masterclass, is A, what the Deferred Sales Trust is, B, what some other options you might be considering besides the Deferred Sales Trust, and then actually telling you live deal stories, either that have closed or are closing, and some of the common challenges or questions that are coming up. Also, it's a great way to be able to share our journey. It's kind of like a journal. Have everyone heard about journaling? I'm never great about journaling, like writing journals, but I think I can do a better job of speaking out loud. It's kind of my strength. And it's just easier to do that. And this is a chance to kind of share our journey with you, so that you can show what's possible and what's some cool ways to be creative. And so, with that being said, I am joined by some amazing people with me, people like my strategic alliances and co-host of the Capital Gains Tax Solutions podcast, Pierce York. Pierce, how are you doing, brother, man? He's on mute. He's going to unmute himself here probably in a second. Yeah, hey, Pierce. So, yes, Pierce out of Newport Beach, commercial agent as well as luxury real estate agent, and one of the more well-known people who know the Deferred Sales Trust, becoming an expert in his own right. Pierce, how you doing?
Good, man. Doing really well. Yourself?
I'm doing great. I'm doing great. And for also, we have Jake Carpenter. He's one of our strategic alliances financial advisors out of the state of Washington. We just closed the big $10 million deal, mobile home park. Jake Carpenter, how you doing?
Doing great, Brett. Glad to be here. Good to see you. Good to see everyone.
Absolutely. And then we have Rebecca Munson. She is a luxury and residential specialist up in Lake Tahoe and Truckee area. Rebecca, how you doing?
Great, Brett. How are you?
Phenomenal. Thank you so much. Good to see you. Great. So let's dive right into a little bit of the vision. And I want to hear from actually Jake Carpenter this time. Jake Carpenter, I'm curious to hear you for the vision of this. I know I've kind of said it, but it's always good to hear it in someone else's words from your perspective. So what would you say the vision for the masterclass mastermind is?
Well, I don't know. Most recently, I've had some conversations with folks that are selling real estate assets and or operating farms. And I think one thing that resonated with me in those conversations is the fact that, number one, they're already trying to go the direction of the 1031 exchange. And sometimes I think as advisors or strategic partners or professionals, we look at these transactions and we go, okay, how do I, sometimes we think that really the 1031 exchange is the direction they want to go, but if it fails, they can have an option to go into the Deferred Sales Trust, which is true. But when I looked him in the eye and I said, is that really what you want? Is like-kind property, trash, toilets, tenants, and liability really what you want to continue with? And he looked at me and said, no. He says, I've got enough land. I'd like to just slow down and retire. So I guess the thing that I'd like to bring up in this mastermind group is don't be afraid to ask people, to look them in the eye and say, is 180-day window, is like-kind property, trash, toilets, tenants, and liability really what you want to sign up for the next 10, 15, 20 years? Or is there something else that maybe would interest you that's a little bit more passive?
I think that's so key, right? And so really what you're diving into here is the identity of what they're going to be doing with their time, their energy, and their wealth, right? And a lot of times the comfort level of the identity of the 1031 or owning investment real estate, doing it yourself, being in control, if you will, full everything that's on your, you can make it happen, right? You can buy the property, you can improve the property, you can renegotiate the loan, you can renegotiate the tenants. And, and it's moving from having, let's say, unilateral control, right, to trusting someone else with that control. And although they might say, yes, I do see that I want this, I definitely want the freedoms, but I also want the control, right? And that tends to be the biggest part of the tension. And so Pierce York, we talked about this actually last week a bit, right? Which is like kind of choose your control. So Pierce, what are your thoughts on that?
Well, the choosing the control is really kind of goes back to your motivation. What do you want? Some people, like I had a conversation with a hotel owner yesterday. They're increasing their NOI, from what he says, about $200,000 a year, which is good. I mean, that's a good increase in income. And so, he's like, look, man, like I don't really want to sell. And he's like, but if the right price comes along, like good. I'm like, honestly, man, like, why would you? Like if you've gotten to this point to where you're gonna, 3 years in a row where you've increased NOI 200,000, like you're cash flowing positive the next 2 to 3 years, if this trend continues, even if it cuts in half, like you're gonna be killing it. Like don't sell. Like it's not worth it, like even if you got the number you wanted, it's probably not worth it because I don't know if you're gonna get a better return, and so it really is just kind of coming down to like what do they actually want? As far as like people in control, what Jay Carpenter said, do you want to deal with tenants and trash liabilities?
Right. Is that the type of control that you want, right?
Yeah.
Because you can have that control, but with that control takes responsibility, right? It takes liability. It takes energy. It takes stress. Essentially, it's on you. And that being said, we're not saying that you don't have control with the deferred sales trust. You have what's called indirect control, and you can always partner with the trust and buy deals, which is actually the rest of the story. But on the first look, we want to start out with this mastermind really nailing or addressing what most people on the first look think that, hey, how do I transfer some of my trust and some of my control to third-party trustee, to third-party financial advisor, to potentially even third-party investment real estate companies or different investments. And so, and the way you do that is obviously by getting educated, right? Getting connected. Connecting with our community, understanding how this works, why it works, what the legality and what the flexibility, what the freedoms that you can have with that. But that also is a part. That takes some work, right? Because commercial real estate folks, I say old dogs. It's tough to teach an old dog new tricks. And growing up in commercial real estate world with my family and residential and in development, it's hard, right? Because we've made so much wealth in it and we've done so well. But it comes to a point where, let's say, the time, energy, and the stress. And as you get older, you're going, you know what? What if I could give up some of that and trust someone else? What kind of return would I have? And so I'm curious on that one, Pierce. You mentioned he has a hotel. Maybe we can run some rough math on that. What's the value? What does he owe? What's his basis? And what is his NOI right now? Do you happen to know what those are?
Actually do. Because I've been coached so well on how to get all that information now. Let me go grab my paper.
It's DST man on the street right here, man in the house. So watch out for kids that are going to dive under his feet.
Kids are flying.
Watch out for Wi-Fi that's going to drop out as he moves away from the router.
No. We're good. So
just go show us the ocean, Pierce. To show us, he's in Newport Beach. By the way, I stayed at this place one time. It's an incredible place. It's like steps from the beach.
Chaos right now in this household with the three little ones. The wife saying negative. Okay. So,
I like the balloon in the background.
Yeah, right.
Keep going.
Okay, so he is currently now. I have seen his revenues. That's it. I have not seen his expenses.
Okay.
So I asked him. I pressed him because he hasn't showed me the expenses yet.
And FYI, hotels are expensive, right? Lots of expenses, but keep going.
Lots of expenses. So gross revenues for 2021 was 1.6.
Mm-hmm.
Gross revenues for 2022 was 1.8. So an increase of 200,000 in revenues.
Okay. Yeah, I mean, that makes sense because of COVID-19 and everything that slowed down the hotel industry. So it went up an extra 200K. Apartments are on about 45 to 50% of the income goes right back to expenses. And I would say hotels are probably maybe 60 to 70, if not maybe more, depending on what it is. So you have to be aware of that, but keep going, Pierce.
Well, so he basically said that he was net of debt servicing and everything profiting 400,000 and at the end net.
It's cash flow. That's net operating income, but that's also cash flow is net operating income minus the debt service, right? So that's your cash flow. So 400 so divided by 12, that's 33,000 a month. Okay. So let's talk about what you think approximately the value might be. Do you have any idea?
I mean, at a 5 cap, we're looking at probably like 8 million.
Okay.
9 million.
Okay, we'll just use 8 for right now. And let's say it was 8%. That's 640,000. Now we're on average, we're able to increase cash flow 30, 40, 50, 60%. So that would be 53,000 a month, right?
He's got 3.9 million in debt.
Oh, okay. So there we go. That's a different one. And what's that, by the way, what's that debt at? Is it fixed? Is it going to set to adjust? What is it?
Yeah, I asked him if it was balloon, if it was ARM. He said no, it was fixed around 5%.
Okay, for how long? Do you know?
I don't know the ending term. He bought the property in 2014 for 4.5 million. I gave him 500,000 in capex. He bought it, kind of renovated already.
Okay.
average, I gave him an extra since he's had it for, 8 years or whatever, I'm sure around there. What this doesn't take into account is any of the depreciation that he's received, but with the 3.9 million in debt and the 5 million, basically all in, right? He's got an additional 1.1.
Okay, let's slow down a little bit because you're moving fast, and I'm following you. But maybe some of the folks are wanting to take. I mean, I have a calculator in front of me. It helps get the numbers down. So we said the cash flow is 400,000. The NOI minus the debt service is about 400,000. I'm going to take that number. I'm going to put it. I use, by the way, an HB 12C for those who don't know what that is. You can store these numbers by putting you can store them in little buttons and you can recall them real fast. It's really, really neat way to keep everything organized when you're doing numbers like this. But I'm going to take 400,000 and I'm going to recall the 8 million minus the 3.9 million, which is the debt. It's going to give me 4.1 million. Take 400 by 4.1. That's a 9.75% cash on cash return. That's pretty solid, right? If indeed that's, and he bought it pretty low. So that's pretty solid. And in that scenario, let's just say we did do a DST, 3.9 million. He'd also have some, some closing costs with the brokers to sell the property for the one-time legal fee. So let's just say that's even 3.7 after that. Who knows what it's going to cost to sell the property. And the question would be, if he made 8%, that'd be 296, right? So that'd be a drop. So in this scenario, if his primary motivation is to keep as much cash flow as possible, this would probably not be a good DST deal, right? Because his freedom is tied to what's called, either passive cash flow, and or it's tied to financial freedom. It suits his lifestyle. Now, as a hotel operator, and he might be a hands-on guy, Pierce, that might be the next freedom you look at, right? So it's not just cash flow; it's also time, energy, and stress. So is he operating himself, or is he hired someone else?
Yeah, he's got a partner there. I mean, it's kind of running relatively good. I asked him, you sell it, what are you gonna do with the money? He's like, oh, I'm gonna put it in another hotel. So he's still in earning years, growing years. He's still in that phase where he's like, the reason that it kind of piqued his interest would be like, hey, if I can catch a premium for this, then I can basically, put it into another property that's bigger, a $7 to $8 million down payment, right? Increase a bunch of my
How old is he, by the way? Approximately.
He's in 50s.
Okay, so he still wants to be involved. He still wants to do it.
Yeah, they're still getting after it.
And that's probably a 1031 candidate, right? The only time I would say it's not is he does a partial 1031 and maybe wants to get out of some debt. Maybe he finds a hotel again for about 4.5 versus it finding one for 9. Because if he sells it for 8 or 9, that means he has to buy that, and he could find that. But let him know that he might have some debt over basis issues, where we would bring in, like a Jake Carpenter or Jake Miller to do a zero Delaware zero coupon deal. So he could replace that debt and not have to feel so burdened by the debt, but still do a 1031, let's say for 5 million, and take on a little bit of debt. So it could be a just more of I would say a debt consolidation plan. Jake Carpenter, I'm going to bring you in on that idea there. What do you think about that?
Yeah, that's always an option. What we want to do is get rid of as much debt as we can with as little capital as possible, so then we can redeploy to maximize cash flow back to the original seller. Especially
takes out Jake Pierce. That's a good comment, Jake. If his interest rate is 5% right now, I mean, I don't know what hotel interest rates are right now. I would think 6.5, maybe 7. Yeah. So one of his objections to selling could be, well, I could sell and I want a 1031, but I don't want to trade debt for debt. And I realize I don't want to get too much debt on a bigger property at a higher interest rate. So you could say, well, why don't you use the DST, a partial deferred sales trust, or even a partial Delaware statutory trust to replace your debt over basis, and then put the remainder into a 1031 regular, and or put some into the deferred sales trust. In other words, there's a number of ways to map this out depending on what he wants to achieve. Go ahead, Pierce. Any thoughts?
Well, it's the other thing too is, I'm going off of what he's saying his NOI is, year-over-year increase, and I have to take him at his word right now, but the financials, I feel always tell a little bit of a different story.
Sure.
And so it really is just I told him, because we talked about this, and I'm like, look, man, like you could get liquid and position yourself right for. There's a lot of people who put bad bridge debt on multifamily, and there's a lot of people who have bought really like assets like probably way overpriced. A lot of 1031 people who made probably motivated buyer decisions, were in hindsight probably not the best decisions. And I feel like in the commercial space, cap rates are starting to decompress, and there's going to be some more deals kind of coming on the pipeline. So
Pierce, what freedom is that? What freedom is that unlocking in that scenario? What is that?
Well, there's a couple different ones. It's time freedom, right? Because you can control the timing of when you go in and out of real estate. There's liquidity freedom. You have the ability to jump on deals when you want. There's asset like kind agnostic freedom, where you don't have to go right back into real estate. There's so many. It's the ability to get down and get in a position where you have maneuverability. I'll even call it maneuverability freedom, right? You can play the market way better when you're able to flow seamlessly, kind of like into deals that make sense, instead of being like confined to time constraints that require you to buy deals.
I think that's spot on, right? And I would add one more: entrepreneurial freedom, right? Because it sounds like this guy's a hotel entrepreneur, and he wants to continue to operate and build his wealth and do that, which is great. I want to bring Rebecca in, because she and her husband have been entrepreneurial real estate, single family home developers in the Truckee Tahoe area for years. So Rebecca, you want to add anything to that, or what are your thoughts on what we're talking about here?
Well, a little bit of the commercial stuff is over my head. I'm following the numbers, so that's great. But yeah, no, especially on the residential side. I mean, the ability, if you want to jump into doing, a different type of real estate, so it definitely gives you an option to leave the commercial side or do both, or, multiple different things, that's what I love about the DST, is that you can diversify, your portfolio.
100%, right? And so you guys build the custom homes, and then you help to broker the deals. So you have the full understanding of like A to Z for anything residential in the Truckee Tahoe area. And what are you seeing right now? I'm curious, like now that things have maybe settled out a little bit, it's the new year, are transactions picking up? What's your sense of the overall marketplace there in Truckee Tahoe?
So it's really kind of gone back to more of a traditional market that we saw prior to COVID. So, a little bit of the transactions picked up right before the new year. Because we're in a resort community, people wanted to buy a place for the winter. And then it slows down a little bit during the winter, and then spring, it'll pick up again. And we have a lot of people that have a lot of disposable income. So we haven't seen huge price decrease drops at all. If a home's priced well, it's selling.
Right.
So yeah.
That's great insight. Yeah. And then there could be some people sitting. I mean, we did a Palo Alto primary home sale for $8 million. And that one was, the biggest thing was capital gains tax. He wasn't ready to sell. And so if prices are maintaining, there's probably maintaining those gains. The Deferred Sales Trust is a great way to help people exit without having to do a 1031. As a reminder, 1031 does not work for anything except for investment real estate, which a primary home is not investment real estate. By the way, we have a guest today. I want to say hello to Warren. Warren, how are you doing today? I want to see if he wants to. By the way, I'm liking the hat. You're on mute there, but I'm wondering if you have any thoughts on anything we've been talking about, Warren. And good to see you too, by the way. And you're on mute, so I don't know if you can unmute yourself.
There you
go. Yeah, how are you, sir?
I'm doing well. Sorry I just kind of got to the party late here, but doing well. Thank you.
It's good. I like the hat. You're looking relaxed. You're looking like you got a good tan on. You got a good jacket there. How are things treating you right now?
I just went to a 60s party, so I grew this beard, so I haven't shaved yet. So, sorry guys. I just did the mountain look real quick.
No, I like it, Warren. What are your thoughts on anything we've been talking about, or you want to add it to anything we've been sharing here?
Yeah, I'm just kind of being a bystander right now, but the thing that I'm kind of liking about this DST for me is it's giving me a little time to just time out of always tending to the TT&Ts, you know. I've got two little 10-year-olds right now, twin daughters, and I'm glad we made this move. You know, we took a couple of years to kind of figure that out. Brett introduced the concept to us probably like in 2019. We weren't ready to sell. We were old school. No, we don't want to do this. We don't want to do this. And we walked through the numbers and they seem to make sense. So I'm just here to continue to learn, and, you know, I'm enjoying what we did.
It feels like you traded the right T's for the right T's. You traded the 3 T's for your 2 twins.
There you go. There you go. Yeah, we feel good. We feel good.
What would you say was the biggest thing, Warren? Because you know, I think this is important for people to hear, right? It took a couple of years, right? And in fact, we were talking, I think I called you right when you guys bought the property, probably 6 months after you bought it in 2008. I mean, so we go back a long time. But what would you say was for you the biggest thing that was like the domino or the aha or the, okay, yeah, I'm now 51% yes, 49% maybe, right? Like, walk us through what that was.
Well, I was going back and forth. We had a kind of a long drawn out sales process, and we had a couple deals fall through. So I kept falling back into, let's just not sell it.
Mm-hmm.
Let's just stay the course. It's pretty solid, but we were out of town owners. And that was starting to really stack up with family life 5 hours away on the other side of the mountains. Rebecca, we live on the other side of the Sierras, the Mammoth side. And that's quite a drive during the winter, or it can be. So, and I'm busy with other places we own. And I just got to the point where the prices looked good for resale or for sale, and the numbers made sense. So that's kind of what we entrusted this plan to be. And so far, so good. So far.
Appreciate you sharing that, Warren. And yeah, Warren and his wife, Catherine, they're amazing clients of mine, and grateful to be able to serve and to help you guys with this next chapter. And what I'm also curious, what was the maybe you could speak for Kat, but what would you say? And I'm curious now too, since we're thinking through this, what was the biggest thing you feel like for her, maybe as like a couple, right? Because you guys have been doing this together for so long. What would you say were the biggest things for her to get comfortable with the DST?
Oh, I think she wanted more time just with the family. You know, I'm the kind of guy that'll just do whatever it takes to make it happen. And that meant I was away from home a lot. And, you know, just more personal time, you know, and our age, you know, we're getting to that time where we want to start enjoying other things besides fixing the toilet.
It's so well said, Warren. And I think also just strategically, you guys were really smart. I mean, you're right. We had to battle through a few escrows, and those escrows, I mean, if everything could have went wrong, guys and gals that are listening to this, I'm a broker as well, multifamily broker. Like, it went wrong. It was a challenge. Like, and we had to like really persevere. I'm like, hey, Warren, Kat, it's like you know, you call it the universe, you call it the market, you call it the city, you call it California, you call it fires. I mean, there was the major fires that, you know, was threatening to burn down Placerville. There was the change in the marketplace with interest rates going through the roof. There was the city. There was finding out. I mean, it was just, I mean,
yes,
it'd be reasons to stop and to stop and to stop and to stop. But I'm like, hey, guys, remember what we originally talked about, what your vision was, and here are the reasons why to persevere and make the deal. And at one point, it was like $10,000 between the buyer and the seller on the third one. And honestly, if that one didn't go, Warren, I think you'd still be holding the property, and you wouldn't be experiencing some of the freedoms you're having now. So talk about what it took to persevere, and maybe encourage some people who are, you know, working through either the DST or just our escrow in general, some encouragement through some of that.
Well, I think our biggest hangup is the city got involved in our sale of our property. And, you know, so
You still there, Warren?
to do this, that, and the other. And it got to be more of a headache than it seemed to be worth. But we just kept going forward, hoping it would work out, and it did.
Yeah.
But yes, we had many times where we're like, this is not worth the headache. Let's just take it off the market.
Mhm.
But it seemed to work. And anyways, like I said before, it's so good to have that freedom. I was so afraid to lose one of our biggest assets, you know. But we're happy. We're glad. Thanks,
Thank you,
Brett.
Warren. Yeah, absolutely. Thank you so much for sharing that. By the way, do you mind if I share some of the stats so everyone can kind of get a feel for those numbers, or would you prefer not to?
No, you can. I don't care.
Okay, cool. Yeah, so the property he sold is 15 units up in Placerville, California. You know, it's outside of Sacramento, downtown, about 45 minutes. And Placerville itself is one of those towns that are very difficult to build in the sense that A, it's just expensive because you're up Highway 50, right, on your way to Tahoe. B, it's like almost like two mountains in a valley that come together, and just the terrain itself, it's historic. It's a beautiful place, next to no vacancy because there's not a lot of housing. This was just down the street from the Marshall Medical Center, and it was also walking distance to downtown. Really cool property, kind of unique. It had like a duplex, a house with a unit on top, a duplex, and then a fourplex, and then 7 units, a couple townhomes. So it was but it was a big parcel. Anyways, we sold it for about $2.5 million. I don't have the exact number with me right now. The basis, I think we estimate it to be around 600 or 500, Warren, if I recall.
I think it's around 7.
7, okay, a little bit higher. You guys had a duplex in Manhattan Beach, not too far from where Pierce is at, and had done a 1031 exchange back in 2008 and wrote it up and bought it for around, I think, 1.2, if I recall. And so the value just about more than doubled. And the other thing we looked at too was I think there was no debt, right? You guys were debt free.
We had like maybe 150 left on it.
Was it 150? Okay, maybe it was a little bit more. And yeah, so 150. And then the NOI, we looked at the estimation of the NOI. We looked at, I'm going to try to remember here, Warren, I want to say, what was the monthly cash flow after debt service? I want to say it was 120,000 is what we estimated, right? Was the NOI?
I think that was after the bottom line. Yeah.
Yeah. So like about 120. And so just do simple math, after all the closing costs and everything else, I think like about 2.35 hit the trust or so. And of that, we're about at 8%. It's about 188,000. So this is a good scenario, right? He was at 120. And now he's at 188. So I take 120 by 188, 120,000 by 188,000. It's about a 47% increase in cash flow, right? Think about that. So in fact, we kind of did this. Me, Warren, and Catherine, we did this. We did like, let's check the boxes for what's on the right side. Okay, so you can increase your cash flow by about 50%, check. You can get rid of the toilets, trash, and liabilities, check. Warren also may, in fact, invest. In fact, he bought a duplex last year in Texas, and he might want to buy some more of those in the future. So he has the option to be entrepreneurial, check. Also, obviously, more time with the family, check. Less headaches, right? So we started to do this list, and then it was also, Warren, control too, right? Because you're like, well, we're so used to, like, this thing is still producing cash flow, and it's, to us, talk about just the durability, because it really didn't ever have vacancy. It just had the rent, and we had really good renters. So talk about the durability already of the cash flow, right? Versus what you're going to get.
Well, the other part, Brett, was that I put a lot of time into repairing and improving the property. So you kind of feel that personal, relationship with your property. So that took a while to kind of let that go. But yeah, it was pretty consistent. It was an older property, so it did have continued maintenance, which became more and more of a bother. Before, I kind of just did it as part of what I was doing, but as time went on, it became like, not again. So we just felt like, gosh, there's other things to be doing besides tending to all these problems. But it was hard to let go because of all the time and the improvements that we did to the property. We had that pride of ownership thing going on. And so that was probably one of the biggest parts,
Yeah, it feels like, and you really did care about the tenants, about the community, about the property, about the blood, sweat, and tears you put into it for so many years. And these properties sort of become like the family, right? Or part of the family, right? And it's like, it's hard to emotionally, finally, wow, forever we're not going to own that anymore.
Yes.
And now moving forward, we're moving on, and that's a big deal. And appreciate you sharing that, Warren. I want to open it up for Pierce, Rebecca, or Jake, or Micah, and or anyone else. Thank you for being on the hot seat there, Warren. That was amazing. So appreciate that. We also have Eleanor. We have I'm not quite sure how to pronounce that name there, but I think it's I want to say Alyssa. Just Alyssa. I'm gonna keep it like that. But yes. Anyone have any questions or thoughts on anything we just discussed? I'm happy to answer and or to discuss.
Yeah, I got a question for Warren.
Sure.
So, I mean, like you said, like the deferred maintenance was starting to kind of catch up with you, and so on. How far away are you from the property?
We're about 4.5 hours.
Oh man, so like you guys were like far.
Pretty far.
Dang.
Yes. So I would get up and, power drive, and get there by 8:30 or 9 in the morning if I took it in my own hands, and then spend like 3 or 4 days over there, just sun up, sundown, and then come home. So, but it's always like a struggle to get what I wanted to get done in that amount of time and not be away from the family. We'd hire most of it out, but it's a lot. It's an older building. It was all kind of built in the 60s. And we just, the cash flow thing that Brett showed us too made a lot of sense too. Like, well, if we could make the same amount of money or more, and not have to deal with this right now, I don't see how that wouldn't be lucrative, in many regards. So.
Yeah, because you don't have the tenant, you don't have to deal all the work, you don't have to spend money on the property, and you don't have to drive down there and spend 3 to 4 days doing it and fixing it.
Yeah, and then you've got, vetting your subcontractors. We found one of our contractors wasn't licensed, and then, we didn't know this because it says licensure on his truck, blah, blah, blah. And then the city gets involved and finds out that he's not licensed, and it snowballed. And it doesn't always work that way, and that's part of owning property, but it just kind of got to a tipping point. And then when Brett showed us the numbers and we had the ability to maybe possibly sell at the top of the market or at a peak, and then maybe see what's going to happen in the future. So it made sense.
So Warren, you had a lot of issues that kind of happened along the way and a lot of roadblocks and hiccups, but now that it's all behind you, I want to know how you feel about it now.
We're early on. We're only about 6 months into this deal, and let's keep it going the way it's going. But who knows, right? We're early on. But like I said, I'm skiing a lot more. I'm doing a lot of other things a lot more. So I just got back from going down. I have property down in Joshua Tree too. So I kind of live in the middle of nowhere. Everything I do is 5 hours away. I'm on my 3rd day of recovery because I went down there for like 10 days straight of just living right in it, man, fixing everything from A to B, A to Z. And I'm trying to maintain, okay, this is okay, but I'm like 63 and I can do this, but I'm liking this DST thing. So we'll see what happens in the future.
Joshua Tree is a good market. It's interesting.
It's a very interesting place. Believe me, I bought property down there in $2,000 for next to nothing because I grew up in Santa Barbara, where property is fairly pricey,
Yeah.
and I never quite got to that point in Santa Barbara where I could afford what I wanted to live in or to invest in. So I went out to JT and bought stuff for nothing. And but it's a very unique market. Your renters aren't the same as they are in Newport Beach. Believe me.
It's crazy. It's absolutely nuts out there. Are you Airbnb-ing it?
I'm not. I could be, but being a kind of a long distance landlord, I'm just not up for that quite yet. I could be. Maybe in time.
Very cool. Thanks, Warren, for sharing, and great questions, Micah and Pierce. Rebecca, you have any thoughts, or what? I see you're unmuted there.
Yeah, I actually, speaking of areas that where you could have purchased property at almost next to nothing, I know of some people that own property outside of Palm Desert, but way outside of Palm Desert. It's an area that's up and coming, and he owns, I think, 10 or 12 properties that he inherited. And so, owned them for next to nothing, and now they're worth 100 or 200,000. I know we talked about the DSD where you do 2 deals that amount to like $1 million or more. Have you ever done a deal where you have, let's say, 10 or 12 properties selling over a course of the year, and they amount to over $1 million? So
yeah. So the main question for Rebecca is
pluses and minuses to doing that.
What's the minimum size deal that you'll consider for deferred sales trust? And it's a good question. And so what we found that it's a home run every time if they have $1 million net proceeds and $1 million gain per transaction. So it's a single transaction. However, they could have 2 at $500,000 each to qualify.
Right.
However, let's imagine they could structure one big deal with one big buyer that potentially we would look at that as well. Yes. Okay. But if we go out there and say, oh, our minimums are 500 or our minimums are this, then everyone shows up to us with 250, and we work on a conditional basis. And so this is where it becomes the ROI just doesn't make as much sense. We found that the closing ratio, when it's lower than those amounts, really drastically falls. Partly because of the complexity and the fees. The fees are about 1.5% to set it up on a one-time basis, and about 1.5% to 2% on a recurring basis. Right. So short answer is, Rebecca, for you, I would take a peek at it, right? Because it's someone that you're bringing in. But I'm not going to promise anything until I see it. And also the tax attorneys as well. We would have to just take a peek at it, if that makes sense.
Right. Now, and I could see if you had one buyer that was willing to buy the 10 or 12 properties.
And it's all one escrow. It's all going to close at the same time. Right. And we're just going to flow it all in there. But every time you break up transactions, there's expertise and new escrows and all this stuff to get it all done. And so, yeah, that's why we typically just say, hey, each transaction, 1 million or more,
right,
have gain and proceeds, or 2 at 500 each that are closing potentially in a short period of time. So, yeah.
Okay.
Yep. Good question. Does anyone else have questions or thoughts?
Yeah, on that, Brett,
yeah.
would you do one deal for 700,000 and one deal for 300,000?
Yeah, sure. I mean, we just did one for 250 for a client out of Texas because he has a $10 million estate and he wants to exit all 10 million into the DST over the next couple of years. And so the whole strategy here was, hey, look, this 250 is not going to be fantastic for you, just so you know, because of the fees, but it gives you a chance to test drive this and get comfortable. Back to that initial premise of this conversation, the biggest challenge for people using the DST is they feel like they're going to give all this control to a third party, where there's also, the reality is it's indirect control, and you still must approve of all the investments and all these different things. But for him, it's like, hey, 10 million all at once is a big deal, but 250 for him was like, hey, I could test drive the DST for 250, right? So that's when we actually did the deal for him, because of just that whole part of it. So sure, yeah, if we want to do one at 700, one at 300, that's fine. But we really want to make this thing a home run and so clear for the client first, and we don't want fees to stand in the way of smaller deals. And so that's when we might explore stuff like cost segregation studies, by buying into multifamily properties as a passive investor or an active doing it yourself. We might just do a 1031, right? Depending on that. So, yeah, honestly, it is a little bit frustrating that it doesn't work for smaller deals, but that's just kind of the reality. Anybody else? Questions or thoughts? This has been fruitful here. You can also put it in the chat if you want to just type it in.
I have another question.
Yeah, go, Rebecca.
So in my community, the Tahoe Truckee area, there's a lot of second homeowners, and I'm sure where Warren lives too, there's a lot of second homeowners. Correct me if I'm wrong, but the DST works for second homeowners if correct, right?
Yeah, regardless, any asset. It can be primary home, it can be a second home, it can be investment home, it can be crypto, it could be a business venture, it can be LLC, S Corp, C Corp. It could be, of course, say crypto already, stock, public or private, carried interest, captive insurance. The DST works for any asset of any kind as long as it has those minimums that we just talked about. So that's a good point, though, because a lot of these second homes may or may not qualify for a 1031 exchange, right? Which is blockbuster restrictive. Where us, we can do all of it, right? Which is why we consider us like a Netflix way of exiting.
Right, and then they could then invest in real estate, commercial real estate or residential real estate if they wanted to, with the proceeds.
100%, yeah. So a percentage of them can go into
partner with
the proceeds that go into the trust, right? Up to 80% can go into illiquid assets as long as they're investment real estate or a business, right? The other amounts can go into liquid investments, stocks, bonds, mutual funds, right? And like the key there is to keep diversification. The key is there to look at the risk tolerance. The key there is to look at what they're trying to achieve, and also kind of mirroring and matching, you will, the promissory note and the cash flow with the actual investments. Like you don't want to be out of whack. Like if someone can delay payments for a couple of years, well, then maybe they can delay the cash flow and look for some bigger investment returns, in a couple of years. But if they need cash flow immediately or a percentage, then we want to make sure we have a percentage of those investments that are producing the necessary cash flow to pay the promissory note. But at any given time, we don't want to overly stretch the trust out to things that are illiquid where we can't get capital quickly to pay for the expenses for the trust. Because this is really a business trust that you've lent the money to in exchange for a promissory note. And so as the trustee, my role, working with the financial advisor like a Jake Miller or Jake Carpenter, we're able to work as a team to achieve, the goal is to achieve that return on investment plus the rate of return, or the original amount plus the rate of return over typically a 10-year period of time. And then every 10 years, you renew for 10 years. But yeah, absolutely. If you want to invest into a primary, not a primary, but an investment real estate property, you can. Primary, you can't. That's taxable. However, you could just take a distribution. Let's say you're selling a $3 million asset and you need $1 million for a down payment. We'll close all $3 million into the trust. We'll send you $1 million immediately. You'll pay tax on that and go buy your primary home with that, right? That's fine. Or along the way, you have a $3 million note, but in 6 or 12 months, you're moving. I have a client, we just did a $17 million deal in Sacramento. He sold a billboard company. And in fact, he just gave me confirmation that I can share his story in my book that's coming out soon, by the way. We have officially changed the title. If you're wondering, it's going to be called, not this, it's going to be called Building a Capital Gains Tax Plan, like exit plan, yeah. So look for that. Okay, that's happening. We're getting a new title, but he's going to be in the book. But the point of all that is he's planning on moving to Tennessee or Florida. So he's flying out and he's like, Brett, okay, I don't want to take distributions quite yet. Let's wait until you're ready, then take a big distribution, pay your tax on that, and then go use it for the down payment. And so that is absolutely flexible there, if that makes sense, Rebecca.
It does. Yep. Perfect.
Okay.
Thank you.
I said a lot there. So, does anyone have questions on that? People can feel free to ask because I just kind of keep going, and then there's probably more questions that pop up.
I have a question that's totally off the topic, but it's a good question.
Sure, that's fine. It could be off topic.
If there's a client who's selling a business and real estate together,
mm-hmm.
and they want to do a 1031, how is that broken up? Say a restaurant.
It's exactly where I was going to head.
Jake
Thanks.
Carpenter, do you want to try this one? Why don't you try this one, and then I'll let you fill in.
Well, my comment to kind of round out the hour was to remind everyone that you can use a deferred sales trust for the sale of a business which does not qualify for a 1031 exchange. And so there could be two parts of a business sale. And this is where, Pierce bringing this up was kind of ideal, because sometimes I have a business owner that wants to sell the business, but he wants to hold on to the real estate. Or they could sell the real estate and not sell the business. And we actually used a little bit of a 1031 strategy to incorporate into the deferred sales trust with our last transaction, Brett. We used the 1031 exchange to address the debt over basis through the Delaware. But you can first initially go into a 1031 exchange and exchange out a certain amount into like-kind property and or a Delaware statutory trust, which is where if you're selling a business and there's real estate that is also part of the business, you can go into the 1031 exchange first, then exchange out the real estate portion with the real estate part of the transaction. And then separate with that, you could go and drop the proceeds from the sale from the non-real estate portion of the business sale right into the deferred sales trust. Did I say that correctly?
I think you did. Yeah. And I just want to just even simplify it even more, right? So, but first of all, the deferred sales trust works for both investment, real estate, and a business. Okay. And sometimes because people don't know about the deferred sales trust, they're having to do gymnastics with values. So what do? Because the business doesn't qualify, they decrease the value of the business and they increase the value of the real estate. And this puts them in a position where if an audit and an appraisal and legit was actually done, potentially they're going to blow it all up because they're inflating numbers just to be able to exchange out into the next. So there's a lot of gymnastics, right, that has to happen on that. In this scenario, we don't have to do that at all. We can sell the business for fair market value. We can sell the real estate for fair market value. They could do a 1031 with the real estate. They could do a deferred sales trust with the business. Okay. They could also use the one deferred sales trust and do a deferred sales trust with both of them, right? Have a promissory note for each part of the sale. So it's really flexible and adjustable, whereas the 1031 is restrictive and fixed. Does that answer your question, Pierce?
Yeah, because I mean, I was talking to a potential seller, and she owns a cannabis cultivation business where she basically grows a bunch of pot, and she's got the business side of things, she's got real estate, and she's like, yeah, well, I want to 1031, and I'm like, listen, you're not going to be able to 1031 the business, so now I'm valuable to you, right? So I just was curious, what, and I don't know, maybe Jake and I have telepathic communication because it just popped into my head over there. So that was funny.
And the other thing is anytime someone is going to consider a 1031 exchange, great. But we like to structure those 1031 exchanges by working with the right facilitators. So if they get in a position where the 1031 looks like it might fail, we can fail that into the deferred sales trust where we continue to have the option of deferral.
100%. That's so important, right? Because you don't want to be what's called 1031 jail. And you want to get with us ASAP for all of your exchanges, whether you're planning on doing the deferred sales trust or not, just in case, because things change, sellers change, banks change. There's 100 reasons why your deal may not work out. And you don't want to be with some of these big QI companies that hold you in 1031 jail. And they tell you, no, we don't cooperate with the deferred sales trust. And you're like, why? And they're like, well, we don't think they're whatever, right? And they have all of their opinions. And in the meantime, we just keep closing them. So make sure you get with us. And we do work with a really good size one too. They're fantastic. They're out of the Bay Area in California, and they work in all 50 states. And they're really, I think, the best, regardless if you use the deferred sales trust or not. But here's the key. If you work with us, you get with us, we connect you with them. then you have the option to do a regular 1031, a Delaware 1031, or deferred sales trust. And yeah, we can do Delaware's with you, and we can help you with that. Of course, we're also brokers. We can help you with the 1031 and sell your property. And of course, we can help you with the deferred sales trust. That's part of why we got here, right? It was just basically like Pierce, we're thinking about solving problems. And every time we solve a problem, sometimes you get bigger opportunities to solve bigger problems. And then you go solve that one, and then the bigger ones come. And that's the cool thing about what we're all here for, is really to solve problems and figure out ways to do it in a better way. So that being said, we are up against the hour here. I want to thank everyone for attending and listening in. I want to especially thank Mr. Warren. Thank you for sharing a part of your story and part of your gratitude. I feel blessed to be able to have you and Catherine and the family as clients, and I won't let you down. I promise you. And we're gonna work and make this thing a success. That being said, I also want to thank Rebecca Munson. Rebecca, if people want to find you, where can they find you?
Probably email or text, but 530-448-9740 or rebeccamunson.com.
Truckee Tahoe luxury and residential specialist. She is the best. She is local. She's been there. She's been doing it for a long time, and she's a developer too with her husband. So she's really, really smart about all of those things. So check her out. Pierce York, if people want to get in touch with you, where can they find you?
You can go to kingdomluxuryrealty.com or the YouTube channel, Living in Newport Beach, California. And you can definitely find me there.
Fantastic. Jake Carpenter, if people want to get in touch with you, where can they find you?
Probably best to email me at jake@carpenter.capital, or you can call Sarah, book an appointment at 509-591-9900.
Phenomenal. If people want to get in touch with me, you can go to capitalgainstaxsolutions.com. Please rate, review, subscribe to our YouTube channel. If you want to become a part of our community and join this masterclass mastermind, you can go to capitalgainstaxsolutions.com. Look for the new book coming out. It's going to look like this, but it's going to be a little bit different title. We have D. Kevin Harrington from Shark Tank in the book, which is pretty cool, and some other really, really smart, fun people talking about real estate, talking about DSTs, investments. Thank you so much, everybody. Have a great weekend. And we'll be here Fridays, 10 a.m. Pacific Standard Time, 1 p.m. Eastern. See you soon. Bye.
Yeah.